What's up, guys? Another episode of UniFiTV here. Do you want to make money by taking out a loan? Sound too good to be true? Well, that's because it is. Today we'll be talking about negative interest rates. Let's get started.
You said in the annual letter this year that Berkshire Hathaway is obviously an interest rate sensitive company, and therefore, consequently, when rates go up, the company will do very well. Do you think we're ever going to see rates going up again?
Well, what's happened with interest rates is really extraordinary. I mean, you could go back and read everything Keynes wrote and everything Adam Smith wrote or Ricardo wrote or Galbraith wrote or you name it, and Paul Samuelson. I mean, you won't see a word of, in my view, anything I've ever seen about sustained negative interest rates. I mean, we are doing something the world hasn't seen. It does have the effect of making all assets more valuable. I mean, interest rates are like gravity in valuations. I mean, if interest rates are nothing, you know, values can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values, and we had that in the early 1980s. So we have gone into this period. Well, Berkshire Hathaway is sitting with billions of dollars of euros in an insurance company that we have in Europe, and they will bear a negative rate. I mean, we would be better off if we had a big mattress in Europe that we could stick all this stuff in. And if I could just find the person who I trusted to sleep on the mattress, you know, that's what we would do. If we have $1 billion of euros at minus 35 basis points, that's, you know, not $1 billion, it would be 3.5 million euros a year.
So like I said in the intro, today we're going to be talking about negative interest rates. So first, what is a negative interest rate and why is it so important? To keep it basic, a negative interest rate is when you pay the bank to keep your money. Sounds absurd? Well, yeah, it is absurd. Now, the reason why I bring this up is because a lot of central banks, especially in Europe and Canada, are now going and implementing negative interest rates. Now, what does this mean for you as a consumer and a business owner? Well, I'll tell you that right now. Like many things in finance, the way negative interest rates work for banks and big brokerage firms is much different than it works for the average consumer. Most consumers do not have to deal with the negative interest rate, so you probably won't have to pay your bank to keep money in it. What it does mean, though, is that banks oftentimes, especially in Europe, like currently in Europe, banks have to spend money. It costs them money to keep their cash in the central bank. Now that's huge because the point and the idea of negative interest rates is to incentivize banks to increase lending. And this is what it all focuses around and how it impacts the consumer. Banks now have an incentive, a huge incentive, to loan out significantly more money to their customers or to anyone, to just consumers, than before, where they would just hold on to that cash and hoard it because they would be making at least slight interest rate, and they'd be making more money potentially off of the interest rate by putting it in a central bank than they would handing it out or loaning it out to consumers. So what does this mean for you? This means that if you are hoping to finance something or take a loan out to get a mortgage, anything like that, now would be a great time if you're living in Europe or Canada, I believe also is considering negative interest rates. Now, to focus in on the United States, interest rates have been incredibly low for a long time. So is it possible that we get negative interest rates? Yes, it's possible we end up getting negative interest rates, and that's the reason why I'm making this video. If for some rare occurrence that the Fed decides to make interest rates negative, they are trying to say, everyone take out loans. Now, a lot of people might feel like they're already too burdened with debt, and completely understandable. But for those who are hesitant on expansion and taking new capital, if negative interest rates occur, that would be the ideal time. What that means is the Fed is trying to say, banks, we want you to loan out as much money as possible to stimulate the economy. Now, like anything, this cannot come without any risks or, possible dangers. So let me tell you about that. What is occurring if negative interest rates get implemented and banks end up deciding to give out? I keep saying give out, but when I say give out, I mean loan out. And they keep loaning out money to consumers. Their hope is that it'll strengthen the overall economy and the money they loan out will come back to them with the interest for profit. Now, let's say the banks loan out all their money or a lot of their money so they don't have much cash left. And let's say we hit another great recession or another weak economy point like we saw in 2008. If banks do not have enough liquid cash on them because they've loaned out so much of it, we would see a huge disaster in the economy. Probably much similar to what we saw in the 2008 financial collapse, where banks and huge investments firms like Bear Stearns simply did not have the cash to maintain and stay afloat. So this is the concern, and this is the risk central banks run when they implement negative interest rates. It's a gamble, essentially, and it is kind of risky. It's high risk, high reward. Currently in Europe, the negative interest rates are not having the effect they want. Europeans right now currently do not want to take on a lot more debt. And so for that reason, even though banks have an incentive to loan out their money, consumers do not want to take on additional debt. Now, for the United States, we have a much stronger economy currently than Europe, which most people might not know about just because of poor reporting in the media, but that's how it is currently. So, there's been a lot of talk during this summer about the Feds raising the rates, and they would raise rates, and we talked about this in a few episodes ago. They would raise rates because they expect the economy to stay strong. And look out for things like job reportings and unemployment filings, because those would determine if the Fed will raise their rate or keep it the same. Now, in some absolutely strange circumstance, the Fed could, in theory, go to negative interest rates. And if you ever, like I said in the beginning of the video, if you ever thought about taking money out, if negative interest rates do become a thing in the United States, which I'm again saying, and I cannot say this strongly enough, that it's very unlikely, but if it does occur, that would be the time to take out loans, because interest rates are naturally going to be lower, because if the Fed set high interest rates, banks have to set higher interest rates to make profit, and vice versa. So, negative interest rates are great for consumers. However, they are risky, which is probably why the United States has not seen negative interest rates. And it's probably why the United States won't see negative interest rates. We, for the most part, on a global scale, we're more fiscally conservative in regards to monetary policy. So even before 2007 collapse, before the financial collapse, our interest rates were still a little bit lower than the interest rates in Canada, which was 4.5%, I believe, in 2007, right before the financial collapse. So, to tie this all up, negative interest rates, if they come to the United States, that would be the time to borrow money. But because interest rates will probably not go negative, they are low currently. They are low. And the United States economy is growing, although sluggishly, it is growing, which means that sooner rather than later, the Feds are going to increase interest rates, meaning that now, more than any time is the best time to take out a loan, because money is just going to become more expensive, and capital is going to be more expensive to obtain. So I hope this is helpful, sheds a little insight on what negative interest rates are and what it means for both the global economy, the national economy, and what that means for you in your business. This has been another episode of UniFiTV. I'll see you guys next time.